11 of 12. This is an extremely accurate way of detecting, is there a recession happening or not? And what you see here is that it's saying, yes, there is a recession either about to happen, it's already happening, or it's just about over with. Well, the Federal Reserve has brought us in for a soft landing and there will be no recession. Or could we already be in one? Let's take a look at the data. This is the 30-year fixed rate mortgages, the blue line. The yield on the 10-year U.S. Treasury is the red line, and the federal funds effective rate. So they've got a target range, and they've got the effective range where it ends up at, which is pretty close. It generally stays within their band that they're trying to target. But the Federal Reserve Fed funds effective rate. And so this goes all the way back to 1954 with the Fed funds rate. And I just want to show you here that whenever the green line is above the red line, that is called an inversion. So that's when this isn't the 2-year and the 10-year inversion. This is a Fed funds and 10-year yield inversion, but it generally does a pretty good job of predicting recessions. And it's got a long history of this. So it gets inverted. The green line above the red, we got a recession. Green line above the red, we got a recession. Green line above the red, we got a recession. Green line above the red, we've got a recession. Here, it was a little bit early. Green line above the red, it took about a year and a half, 2 years before the recession set in. Here, it was early again, but about a year and a half before the recession started. Here it was early, year and a half when it predicted, and it even predicted the recession during the lockdowns. Somehow, that was pretty amazing that all these different factors predicted that there was going to be something that ended up happening as a cause of the lockdowns, but that recession. So, the big impact here is the change and the speed of the change of the rise in the Fed funds rate and how bonds have been going. They bottomed in March of 2020, and they've been going up since. So this is the 10-year Treasury going up, and how that affected the 30-year mortgage. And this mortgage rates are extremely important, especially in the commercial real estate industry, where they're making all of these enormous office buildings unprofitable because the value of an office building is based by the cash flow, which is based on the occupancy rate. And so if the occupancy rate goes down, so this makes it very hard to refinance those office buildings. And the refinancing, a lot of it is coming due now. So let's move on to the inversions themselves. So here we have the 10-year minus the 2-year. That's the one most often referred to. The 10-year minus the 3-month Treasury, and the 10-year minus the Fed funds rate. And this goes back to 1961. Not all of the data. That's just the 10-year and the Fed funds rate. You see one false flag there, but it's been a very good predictor of coming recessions. And then the 10-year minus the 2, the blue line, is the one that is most often referred to. And it has also been an excellent predictor of coming recessions. And it's been more than a year now that this has been predicting that a recession was coming. But very often, this is early. Another predictor. This is a very interesting chart, although I have a big problem with it. I'm pretty darn good at reading charts. If you don't think so, go to ggsr21.com and take a look at Chapter 3 of my book. Chapter 3 and 4 are online only, and they're free. Everybody can look at it, but it's a primer on how to read charts. And one of the things about this chart, this is bankruptcy filings surge to dangerous levels. And yes, we've been up at this level at the onset of the 2008 Great Recession that led into the 2009, market crash, the global financial crisis of 2008, the COVID pandemic. And here we are back up at these levels. But what is this level? It's a level of 8.5. It's a 4-week moving average of U.S. bankruptcy filings. So does that mean that there's 8.5 filings in the last 4 weeks? Well, that's sort of what it suggests. It doesn't, there's nothing in the legend here. It's alarming, regardless. But is this 8.5% of all the publicly listed companies? What is it? I don't know. It's an alarming graph. I wish they would have said what this graph truly is, what it represents. I want to know, what is this scale? What is it measuring? The line is a 4-week moving average of whatever it is measuring, but it doesn't tell us what it's measuring. However, it's at alarming levels that says that right now something like a bad recession should be setting in. My farm manager, I was up at the farm last weekend, and I was up at the farm back in February at my birthday. My farm manager came into town yesterday for something that he had to do in San Juan, and so we had a meeting, and we went to a restaurant last night at about 5:30 p.m. to 7:30 p.m., this beautiful rooftop lounge. And I don't know if you're noticing business slowing down, discretionary spending slowing down where you live, but I am noticing it start to happen here. This is a beautiful rooftop lounge on the top of a hotel, and this is one of what is considered the better restaurants in town. And this rooftop lounge is, granted, this was a weekday. And so, but normally on a weekday, this can fit maybe 60 or 80 people in this rooftop lounge, possibly more. And on a weekend, it may usually be packed, but I don't believe it is. And then this weekday where I was there, this was actually just yesterday. The video I'm making now is going to be released tomorrow. So this is on Wednesday I'm making this. This was a Tuesday. The traffic from this place that would normally have 20, 30, 40 people in it, the total occupancy of this restaurant from 5:30 to 7:30 was 2, me and my farm manager, Nicola. And I felt so bad for them. I want to show you this. This is the U.S. Department of Labor wage and hourly division. And the way they do this, minimum wages for tipped employees. So this includes the service sector, like, waiters and bartenders and so on. And so federally, $7.25 is the minimum wage, but they have a special minimum wage. They calculate that the amount of tips that waiters and waitresses and bartenders get is about $5.12 per hour, is the guess that the IRS is making. And so the minimum wage that a business can pay them is $2.13 per hour. So a lot of people don't know that wait staff gets really cheap. I'm not for minimum wage. Minimum wage is $0 because a business does not have to hire you. That's the true minimum wage. Nothing per hour. You push minimum wage up too high, and that is what you get, is a business will decide to automate, to close, to just eliminate that job somehow if it's not a profitable job for the business. Every job must generate a profit for the business, or the business must die. That's the cruel reality of economics. But the definition of a tipped employee is somebody making more than $30 in tips per month. That's federally. Now, I want to skip down to Puerto Rico because that applies to this restaurant. It's right at the bottom of this thing, but in Puerto Rico, the minimum wage is $9.50 per hour. They calculate that $7.37 of that if it's a waiter or bartender, that $7.30 per hour is coming in as tips. So the business can pay you $2.13 per hour. So that's what most waiters, waitresses, and bartenders are being paid on their paycheck in Puerto Rico. And we were the only two people there. We had a couple of hamburgers and a few beers, and the bill was $100 for a couple of hamburgers and beers. And so I put $20 a tip on the bill, and then I was walking out and I saw that we were the only people there over that 2-hour period. So basically, they each made $4.26 over that 2-hour period where we were there, and I felt so sorry for them. I handed them another $10 on top of the $20 I had already tipped on this outrageously expensive $100 pair of hamburgers. And so business, there should have been at least 20 or 30 people up there, and there were 2. And so I'm starting to see this, especially like midweek, restaurants and so on, starting to slow down. What is it like in your area right now? Especially pay attention to like midweek stuff. And so, Treasury Secretary Janet Yellen tries to calm markets amid historic U.S. bond collapse. So here's Market Insider calling it a U.S. bond collapse. And further down in this article, it says that since March of 2020, that's when bond yields reached their minimum and then started rising. And when they rise, the bond prices fall. So this says that the 30-year bond is down 53% according to Bloomberg. Now, the inverse of if you bought a bond for $100 and it went down by 53%, that means it's worth, you can sell it for $47. But that is the price. What is the value? Looking at this, you have to say, I invested $100 in March of 2020. I could have bought $100 worth of March 2020 goods and services. How many goods and services can I buy with those dollars today? So if you go to the CPI calculator and you go from March 2020 to August of 2023, $100 put into bonds then would require $119 to purchase the same amount of stuff today. So we've had a 19% inflation since the bottoming of the bond market, the bottoming in yields, which was the peak in price. And now things are falling. So of this, going back to this 53% crash, if you have $100 and it crashes by 53%, that means you've got $47 left. Now we want to deflate this by the amount of inflation to see what the value is left in bonds. So instead of going from March of 2020 to August of 2023, I'm going to deflate it going backwards. From today, August of 2023, they don't have the September data in yet, back to March of 2020. And that requires a 16%, deflating it by 16%. To figure out what the actual purchasing power is. And what you end up with is, this $84 that's left out of the 100. You end up with of 84% of 47 is $39.48 worth of purchasing power. So that is how much. So the bonds, the 30-year bond, has crashed by more than 60% already. Are we in a recession? So why does this bond market collapse matter? Because the bond market is the largest market on earth and absolutely dwarfs the stock markets. That's the reason it matters. Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. This is something else that I look at. In my first book, Guide to Investing in Gold and Silver, I have some updates on things in the 2015 edition. And one of the things that I had identified near the end of the book, I call it the dangerous fog. And FOG stands for Financialization of Government. And what I noticed here was that there used to be no correlation between the value of the stock market. I used the Wilshire 5000 total market full cap index, and I noticed that the tax revenues brought in by the government looked like the stock market. And I put these things on the same chart, and lo and behold, when the stock market collapses now, so do tax revenues. There used to be no correlation before the year 2000. This is only a phenomenon of this century. And so here are federal government current tax receipts. I'm going to raise this so that my eyes are closer to looking at the camera when I'm looking in the chart. And what we see here is this collapse with the NASDAQ crash in 2000, the collapse with the global financial crisis of 2008. This is a collapse of tax revenues. And then we have this huge collapse going on today. Now, I'm going to modify this graph a bit by going from billions of dollars to percent change from a year ago. So this is either the growth or the shrinkage of tax revenues in the United States. And here is what is, I'm going to make this even easier to read by, it's on semi-annual. This smooths the data a little bit and makes it just a little easier to read. So this goes back to 1948. And as you can see, it goes negative and we have a recession. And then it goes negative again in 1953, and we have a recession. It goes negative again in 1957. We have a recession. It goes negative again in 1961. That's at the end of the recession. But it has very, very accurately pointed out recessions either just before they happen, in the middle of when they're happening, or just about when they're over with only one and two false flags, and one where it did not point out or predict the recession. But out of 12 recessions, it correctly flagged 11 of 12 recessions with two extra false flags, and not predicting that one. So 11 of 12. This is an extremely accurate way of detecting, is there a recession happening or not? And what you see here is that it's saying, yes, there is a recession either about to happen, it's already happening, or it's just about over with. And recessions are trailing indicators. It's something you don't find out until 6 months to a year after it happened. Is they say, we've been in a recession for the last 6 months or the last year. And so, if you take a look at my video from 3 weeks ago, or 2 weeks ago, I'm sorry, all hell is breaking loose. I show the national debt clock, and normally all the figures on it are rolling over forward. They're getting higher and higher and higher, but every year they roll over at faster and faster rates until it's just absolutely blinding. But now there's stuff increasing at the fastest rate ever, while other things like the currency supply and tax revenues, credit card debt, all of this stuff is going backwards at these amazing rates. So there's stuff collapsing at the same time that debt is expanding. And it is like our politicians now sort of sense that the end game must be near, so they've got nothing to lose. They're just going to they're going to buy votes by spending us into oblivion. And that leads to not just a market collapse, but the potential of a currency crisis and like total financial catastrophe. A real, I don't know. Now, this is from Zero Hedge, and I wish they would list their source, because they say we've added $513 billion in total debt over the past 18 days. So total debt, the best way to measure this would be to go to the Treasury and look at the Treasury auctions and the Treasuries that have been retired. Take the net difference between the new Treasuries that we're adding and the old Treasuries that are now paid off and nothing to worry about. They're closed. We've retired them. So I'd love to know where they got their data. But this is probably part of it. We've canceled $127 billion in student debt for nearly 3.6 million Americans. Now, this sounds good, but did Joe Biden have $127 billion that he could pass out? Was this his personal gift to the United States? Who actually pays for this $127 billion going to 3.6 million people? Now, it sounds real generous, and this probably bought 3.6 million votes by doing this. However, who pays for this? Who is it that actually foots the bill? There's 330 million people in the United States, but there's only about 127 million taxpayers. And as you know, the government the government's two big jobs are wealth redistribution. And let me see, there was a quote, I can't remember who this is from, but somebody just sent this to me yesterday about him being tired of old men sitting around in air-conditioned offices in Washington, D.C., planning wars for young men to die in. And so the government's job is to take our wealth from us if you're working and redistribute it to other people. And once it's theirs, they think that once they've taken it from us, they think it is theirs. It's their birthright to just spend this on whatever they think is important. And so here, the average taxpayer has paid $1,000 for the education of these other 3.6 million people, $1,000 each per taxpayer, and it's not evenly distributed. Some people are paying $1, some people are paying $100,000 or $1 million to educate. And education is a good thing. I'm not arguing against that. I'm arguing against the redistribution, and these people that took on this student debt made a promise, and they had a responsibility. Now, there have been two great economists during my lifetime, only two that I can point to and say, that man is a truly great economist. And one of them is Thomas. He's the only great living economist, in my opinion. You cannot subsidize irresponsibility and expect people to become more responsible. He's not just one of the world's great economists. He is also this great observer. There is one thing, the two great economists are Thomas Sowell and Milton Friedman. One of the things about them is they are men of very clear vision. They can look at a big picture of the whole society and see that this plus this equals this. They've got this very, very clear vision where they can connect the dots and add things up. This is a great quote. The interviewer says, if you abolish the Federal Reserve, what do you replace it with? And Thomas Sowell says, when you remove a cancer, what do you replace it with? Nothing. You just let the free market work. So the thing to pay attention with all of this massive deficit spending, we're doing these massive spending increases at a time when revenues are falling, and they're not done falling yet. As we truly enter a recession, tax revenues fall even further, GDP, and then if it turns into a crisis, it falls even further. And their thinking is that the only way to resolve this, the only way to get us out of it, is to spend more of what you don't have. And so I want to leave you with this amazing little lecture that's only 36 seconds long by Milton Friedman, one of the two great economists of my lifetime. And I want to thank Peter Spina for pointing this out to everybody. So here is Milton Friedman.
Keep your eye on one thing and one thing only, how much government is spending, because that's the true tax. Every budget is balanced. There is no such thing as an unbalanced federal budget. you're paying for it. If you're not paying for it through it in the form of explicit taxes, you're paying for it indirectly in the form of inflation or in the form of borrowing. The thing you should keep your eye on is what government spends. And the real problem is to hold down government spending as a fraction of our income. And if you do that, you can stop worrying about the debt.
Okay, so what he's saying here is that government spending is what causes us to sink or swim, and the more government spends, the more it's tying a weight around your ankles while you are trying to keep your head above water. I want to thank you for watching. Please like and subscribe. And, if you want to support this channel, consider buying from GoldSilver.com if you make a decision to buy any gold or silver. Thank you for watching. Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway where you can win 1-1-1. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.